You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by OLLI Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through OLLI Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest, Senior Options Analyst and author of The Options Playbook. All right, so I'll get this out of the way. It is Thursday, June 16th. The markets are open and they are rocking and rolling as we tape Options Playbook Radio. We're going to do a very short-term trade only because we can. It has a lot to do with where the markets are at right now. We have the S&P 500 index down, and that has brought the VIX up to around the 32% level. Because of that, we're going to do a trade this week in the S&P 500 index. We're going to continue to be bearish. Obviously, the Fed came out this week, decided that we needed 75 basis point hike in the Fed funds rate. Markets took it as a positive, but today they're bringing the markets lower. And so I guess we're not going to fight that the direction of the market anymore. We're going to come up with a trade this week that I've done many times in the past. I always like to interchange between butterflies and long spreads. A lot of times, especially the way the market was, the bull market, because we're officially not in the bull market anymore with where the S&P 500 index is at. You would do a long call spread, and if things went against you, I would roll that into a butterfly. So today we're going to actually do it on the put side, and we're going to actually make the forecast that the market's going to go down over the next day, going into Friday, this expiration. And if it goes against us, we're going to actually adjust it and roll into a short put spread. Now, the requirement is fairly substantial if we do this trade, and we have to adjust it. So we're going to start with very little risk relative. And if we make an adjustment, it would be because the way the market has gone and the fairly high probability of success on the trade, but we would still have risk. So whenever you have risk, there's always a chance, especially in a marketplace like this, that the worst case scenario could happen. Okay, as almost every option trader knows that is out there, that if you've been trading options and you've never had the worst case scenario happen to you, that means you haven't been trading options long. With that said, let's get into last week's trade before I talk about this week's trade and the adjustment. So we might be a little bit long-winded this week on Options Playbook Radio, but last week we're just trying to look for something that might have some upside, and that's very hard to do in this marketplace. But we had Target come out and talk about their inventories and how they poorly managed their inventories, and that they're probably going to be fire sailing some large big ticket items like washers, dryers, et cetera, et cetera. So one of the companies that can benefit from that are the bargain outlets, and Ollie's is a bargain outlet that has a very big presence in the South. And I live by Charlotte, North Carolina. Actually live in South Carolina, right across the border. But with Ollie's, when we're looking at what they have, is a lot of cash on hand, and they can make big purchases. And if they want to get rid of inventory quick, all the bigger firms know that they can go to Ollie's, and they're going to get cash now. So with that said, we looked at maybe selling a put spread, selling a cash secured put spread, saying that if the stock came down, I might be willing to buy it. But if it goes up, I'm happy to take the premium, mainly because everything in this marketplace has fairly high volatility. And Ollie's was no different. It was trading at about 65% implied volatility. We had the stock last week trading right around 55, and we sold a July 15th 50 strike put and bought the 45. Now, we talked about the fact that they're not extremely liquid options. It's part of the reason why we did a short put spread, because if you're correct on your forecast and the options go out worthless, you don't have to worry about bid-ask spreads. It is still a concern if the market does go against you, though, because you might be forced to close your position fairly quickly. Bottom line is we sold that 5-point wide spread. The midpoint at that point in time when we did it was at $1. And so we had $4 worth of risk on our 5-point wide spread because we brought in a $1 credit. Well, the market actually did go up in Ollie's, and it continues to. If you consider what's going on in the marketplace, it's doing amazingly well. If we look at the underlying stock today and where that trade is at, the stock is actually down today, but it is trading higher than it was last week when we looked at the trade. So interesting enough, when we looked at the trade, and I did my little screenshot, because a lot of times we'll tape and the markets will be open while we're taping. And last week, the stock was exactly at $55. And now my screenshot today, we're exactly at $56. So we had 1 week of decay. We had the underlying stock go up $1. We put this trade on for $1 net credit to the account, and we could close it right now for 80 cents. So hence we could make 20 cents on the trade. If we closed it out, I would probably just stay the course at this point in time. The market's going in the right direction. And we did also say that if it did come down, maybe we'd be willing to buy it at 10% lower. The market was at $55. We sold the 50 strike put. The math is fairly simple there. 5 points on a $55 stock is about 9%, saying that if the market came down to 50, we would be looking we'd be willing to buy it. But just in case the market does crash, we're going to buy that 45 strike put, give up a little bit of the premium that we were bringing in, and be able to protect ourselves on the downside. So I guess the moral to the story was, if there is a stock out there that you wouldn't mind buying, I'd rather do a short put spread with the intention of buying the stock if it came down to the short put strike, as opposed to just selling a cash secured put. The marketplace is just too risky, and you're getting a lot of premium anyways, because most underlying stocks are trading at higher implied volatilities over the last 4 or 5 months, without a doubt. Okay, so let's get bearish. So as always on Options Playbook Radio, nothing is ever meant to be a recommendation. But this is one of the trades that I have done a lot over the years, and I'm going to use it in the S&P 500 index. I think it's the easiest thing to explain, but I've done it in underlying stocks. But it's the concept that butterflies are cheap and they're easy to adjust. So we're going to do a very short-term trade, though. So the adjustment would be at the end of the day if the markets did rally. So as I mentioned, it is Thursday. The markets are open. It's the morning that we're taping this. The S&P 500 index is currently down just over 120 points. Last trade was 3,668 and some change. And we're going to go a little bit out of the money. We're going to go about 20 points wide. Now, with the VIX at 32, these butterflies are cheap. Normally, if I was looking at this trade, I would need some more time premium to get it to a feasible price to pay for our butterfly. And so I'd usually put it together on Monday or Tuesday. But because the VIX is high enough, we can do this on Thursday, and it's fairly inexpensive to put this trade on. We're going to go 20 points wide. We're going to go a little bit out of the money. We're going to use that June 17th expiration. Now, on June 17th, there is a normal Friday expiration that is a monthly option contract, and we want to make sure that we're doing the weeklies. So if you look at the option chain, you have to, especially in the Ally Invest option chains, we put a W next to the one that is the weekly. That means that those option contracts actually trade all day on Friday and trade into the close. So the W stands for weekly, and that's the expiration that you want to choose. The SPX option chain is the most confusing option chain by far in the marketplaces because they have a mixture of monthly options that are European style and weekly options that are American style. So you can do some research. If that was confusing to you, that could be a show in itself. But bottom line is we're going to use that weekly option. That means that these option contracts are going to trade all day on Friday, and the settlement will be determined on the close. Okay, here we go. Here's the trade. We are looking to buy one of the 36.75 strike puts. We're going to go 20 points down and sell two of the 36.55 strike puts. And then another 20 points down and buy one of the 36.75 strike puts. This is 1 by 2 by 1. It's a standard butterfly, doing it for a net debit of $1.65 to the account, or $165 plus commission to put on the trade. You are 20 points wide on this trade, and you have 1 day for these option contracts to live. So you want it to land within a 40-point range, and the 165 is really inexpensive from all my years of trading to be able to do this with only 1 day remaining to expiration. So time decay is your friend. If the market did come down to the 36.55 level, remember it's 36.68 right now, you would want to get out. You'd want to get out fairly quickly, and there's going to be still a lot of juice in it. So don't be thinking you're going to try to put this on for $1.65 and sell it for anywhere close to 20. If you double on the situation, you can sell it for $3.50, $4, or even $5. You want to get out of the trade and just move on. It's not a trade that you want to screw around with because there's just a lot of risk in it, but we're not putting a lot of money up front for every butterfly that we're put on. Okay, so let's say we put this trade on and the market does go against us and it continues on up. One of the things that I like to do then is actually sell the most expensive put, which would be the 36.75, and then go and buy another of the least expensive puts, the 36.35. Now, I want to make sure that I'm doing this for about a net credit to the account of around $5 if I could. And so if I look at that trade right now and I see where is the roll at in this position, we'll see that right now that is going to be a very expensive trade. But remember, we're protecting our position. Okay, so on the roll right now, it's trading for about $14. And that basically would mean that we're doing a short put spread. So if the market goes up, then obviously that net credit from the roll is going to go down. And that's what I want to watch. So if I see the marketplace totally reverse, take back all the losses today, on the way up, if I can see that roll trading at around $5 or $6, I'm going to think about doing it. But if I do it, I create 2 short put spreads that are 20 points wide. I create a situation where I have $4,000 of margin that I'm going to have in my account to put that trade on. Now I'm going to bring in a net credit. This is totally, I don't want the cheese anymore. Just let me out of the trap. I would make a small amount, but I'm going to have to put on a lot of risk to do that trade. So in this scenario, we're hoping that the market continues on down. And if the market does reverse today, or even if it just stays where it's at, this butterfly can do fairly well with 1 day left to trade and 1 day of time decay. So if we drift lower, that would be a good thing. If the market goes up, let's say 40 points from where it's at right now, I would want to look at the spread and I would think about rolling it into a 2x2 short put spread. So let's recap that. There's a lot in that, a little bit hard to do in a podcast as opposed to having a little bit of a graphic. But in this scenario, we initial trade would be with the S&P 500 index at 3668. We are going to buy to open to 3675, 1 contract, sell to open to 3655, 2 contracts, and then buy to open the 3635, 1 contract. This is the June 17th expiration, so you have all day today, all day tomorrow for these option contracts to trade. Looking to do it for a net debit of $1.65 to the account. That means $165 plus commissions for every 1x2x1 butterfly. If the market comes down, this trade is easy. If you see it at 36.55, I would think about just getting out, no matter where the market is truly at. Realize you're not going to get paid if it happens right away. It would be better if it happened at the end of the day that the market came down to that level, just because of the amount of time premium that are in SPX options. If the market does go up, let's say 40, 50 points, it makes a bounce. We might roll this position, try to make a few dollars out of this trade. And the roll would be, we would be selling to close the most expensive option contract that we own, which is the 36.75, and then buying to open the 36.35, effectively rolling into 2 short put spreads. If we did that, looking to bring in a net credit to the account of about $5 or $6. That trade right now, that roll is trading right around $14. That was a lot. Interesting trade, though. I always have been interested in the concept of rolling from a butterfly into a long spread and from a long spread into a butterfly or into a short spread every once in a while, those type of things. Basically, that's all a butterfly is 2 different spreads, right? You have a debit spread, and then you combine that. Well, I should say that I guess the best way to say it would be you have a long spread combined with a short spread, and they share the middle strike, and that's what makes up your butterfly. Okay, that's it for this episode of Options Playbook Radio. If you have any questions you'd like me to try to answer on the program, please send them to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold to finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.